Welcome back to the Deep Dive. Really glad you could join us.
Great to be here.
Today we're tackling something that can feel a bit overwhelming maybe, like trying to read a different language sometimes.
Investing. Yeah, it definitely has that reputation.
But it's so crucial if you're aiming for, real financial freedom, that ability to live without limits.
Absolutely. And it's key for that entrepreneurial spirit too, which we know a lot of you listening have. It fuels those big dreams.
Definitely. So today we're cutting through all that jargon. We want to give you simple, practical, and hopefully motivating knowledge. This is our deep dive. Investing basics you wish you knew sooner.
Yeah, and our goal today is pretty straightforward. We want to show you, first off, that you don't need to be rolling in cash to start.
Right.
Then we'll cover the really essential financial groundwork you need before you even think about investing.
Okay, the prep work.
Exactly. And then we'll look at some simple, really accessible ways for beginners to actually get started.
And importantly, we'll also touch on the mindset, right? Those shifts in thinking that are key for sticking with it long term.
Couldn't agree more. It's huge.
So if you're ready to grab the reins of your financial future, kind of move towards that life where money isn't the bottleneck. Well, you're definitely in the right place. Let's dive in.
Let's do it.
All right, so let's unpack this. When people hear investing, they often picture like flashing stock tickers, maybe Wall Street.
Yeah, the movies haven't helped there.
Probably not. But our sources are really clear. The real work of investing. It actually starts before you pick any stock or fund. It starts with setting up your financial foundation.
That's such a good way to put it. It's like building the launch pad before the rocket takes off.
Okay.
And there are a few, foundational non-negotiables, as we call them. First up, absolutely critical, your emergency fund.
The rainy day fund.
Exactly. But it's more than just for rainy days. You need ideally 3 to 6 months of essential living expenses tucked away.
3 to 6 months. Okay.
Well,
and where should that be? Just in a checking account?
Preferably not. You want it readily available, yes, but in an easy access savings account. Some are paying close to 5% right now, actually.
Wow. Yeah.
And the key reason for this, besides just peace of mind, is it protects your investments. If you hit a rough patch, lose your job, unexpected bill, you won't be forced to sell your investments when the market might be down. You avoid selling at a loss.
Okay. So it's a buffer specifically for your investing strategy too. That's a really important link.
It is. It keeps you from making bad decisions under pressure. Now, the next non-negotiable, tackling high-interest debt.
Right. The bad stuff. Credit cards.
Precisely. We're talking credit cards charging, 20, 24, maybe even 25% interest. Paying those off needs to be a priority before investing.
Because the interest is just so high.
It's practically a guaranteed return. Think about it, paying off a credit card with 24% interest. That's like earning a 24% return on your money, risk-free, tax-free.
Wow, when you put it like that.
You're not going to reliably find that anywhere else. Let's say you owe $1,000 at 24%. Pay $200 a month. It's gone in 6 months. You pay maybe $58 in interest.
Okay.
But if you only pay, say, $50 a month, it could take over 2 years, and you'd pay like $250 plus in interest. It's like trying to fill a leaky bucket. Plug the leak first.
That makes total sense. Fix the leak. Okay, so emergency fund topped up, high interest debt gone. What's next for building this financial launchpad?
Next up is the power of, budgeting and saving. And budgeting isn't about being miserable or restricting yourself.
Yeah, it gets a bad rap sometimes.
It does, but it's really just about understanding where your money is going, knowing your income, knowing your outgoings. Like Graham Wells said, trying to fix everything at once rarely works. Focus on small steps that compound.
Small steps, yeah. I like that. It feels less daunting. Is there a simple rule of thumb for beginners?
A really popular one is the 50-30-20 rule. It's a guideline, obviously.
Yeah, 50-30-20.
So roughly 50% of your after-tax income goes to needs rent, food, utilities. Then 30% goes to wants eating out, hobbies, new clothes, that kind of thing.
Fun stuff.
The fun stuff, yeah. And the crucial part, 20% goes towards savings or paying off debt beyond the minimums.
20%.
And you can tweak those percentages, of course, but think about it, someone earning, say, $2,000 a month after tax. Putting aside 20% means they save $2,400 in just 6 months. It adds up.
That's pretty tangible. But making sure that 20% actually gets saved, life happens.
Totally. The key here is automation. Set it and forget it.
Yes.
Set up automatic transfers to your savings account. or extra debt payments right on payday. Sarah Coles put it perfectly. If you wait until the end of the month to see what's left, you can be almost certain there will be nothing.
Guilty as charged sometimes.
They've all been there. Also, look into those roundup features on banking apps. You spend $1.87, it rounds up to $2 and puts the 13 cents into savings. It seems tiny, but it accumulates.
Little drips fill the bucket. Okay, automating is key. What about when, hopefully, our income starts to go up? Raises, new jobs.
Ah, the danger zone. This is where lifestyle creep sneaks in.
Meaning,
As your income grows, your spending tends to magically grow right along with it. A bigger house, a fancier car.
yeah, I can see that happening.
So a really powerful wealth-building move is to resist that urge. When you get a raise, try to invest most or all of it rather than just spending more.
Yeah.
Doubling your savings rate often has a much bigger impact over time than chasing slightly higher investment returns.
Really? More than finding a better investment.
Absolutely. Think long-term. Investing, say, $50 a week for 40 years at 9% might get you to $1 million. Okay, great. But investing $100 a week, that gets you $2 million. Same return rate, just saving more. It's huge.
Wow. Okay, that's a powerful perspective shift. It's about the rate of saving, too. What else should we watch out for in our habits?
It really helps to know your own money weaknesses. Are you an impulse buyer?
Maybe sometimes. Online shopping.
Yeah, so maybe delete the shopping apps or use a 24-hour rule. Put something in your cart, wait a day, see if you still really want it.
Good idea. Cooling off period.
Exactly. And actually tracking your spending, even just for a month or two, using a spreadsheet or an app, it can be genuinely transformational. You see patterns you never realized.
Painful, maybe, but transformational.
No, could be. And finally, just be kind to yourself through all this. Nobody teaches us this stuff formally. It's okay to slip up.
Yeah.
Focus on progress, not perfection.
Yeah.
If you're feeling overwhelmed, list your worries, tackle them one by one. And don't be afraid to use resources like Citizens Advice, Step Change for Debt Help, Money Helper, or even educational sections on sites like Hargreaves Lansdowne or AJ Bell.
That's great advice. Be kind. Take small steps. Use the help that's out there. Okay, so we built the launch pad. Our finances are getting tidier. Now, here's where it gets really interesting, right? Why is investing actually different from just saving? And how does it, turbocharge that journey to freedom?
Yeah, this is the core concept. Saving, like we talked about with the emergency fund, is mostly for short-term safety, creating that buffer.
Right.
Investing is for long-term growth. It's designed to make your money work for you and, crucially, beat inflation over time.
Inflation, the silent wealth killer.
Exactly. Cash in a savings account, even earning a little interest, often loses purchasing power over the long run because prices go up. £1,000 saved in 1999 might be worth, say, 2016 now in cash, but due to inflation, it might only buy what 1,856 could buy back then.
So it grew, but it didn't really keep pace.
Right. But if you'd invested that same £1,000 in, say, the UK stock market, historically it might have grown to something like £3,300, actually increasing your purchasing power significantly, even after accounting for inflation.
Okay, so investing is about making your money grow faster than the cost of living.
That's the goal. And this leads us to, well, what Einstein supposedly called the eighth wonder of the world.
Compounding.
Compounding interest, yeah. It sounds complicated, but it's simple, really. Your money earns returns. And then those returns start earning their own returns. It creates a snowball effect.
Like interest on your interest.
Precisely. Let's say you invest $1,000 a month and get an 8% average annual return. It might take you around 7 years to hit your first $100,000.
7 years, okay.
But because of compounding, the next $100,000 might only take 4 years, and the one after that, maybe just over 3 years. Your money starts working harder and harder for you. It accelerates.
Wow. That really shows the power of starting early and just letting it work.
Time is your biggest ally with compounding.
So how do we actually start putting this magic to work, especially if we're just beginning?
Well, it starts with getting clear on your goals. Why are you investing? Retirement, a house down payment, kids' education.
Okay, knowing the why.
And link that to your time horizon. When do you need the money? If you need it soon, like in the next couple of years, you generally want lower risk investments.
Because there's less time to recover from any dips.
Exactly. If your goal is decades away, like retirement, you can typically afford to take on a bit more risk for potentially higher growth, knowing you have time to ride out the market ups and downs.
Makes sense. Align the risk with the timeline. But speaking of risk, that's the scary word for a lot of people.
It is, and it's important to understand. All investments carry some level of risk. There's no free lunch. Generally, the higher the potential return, the higher the risk involved.
Right.
The key is figuring out your personal risk tolerance. How much fluctuation in your investment value can you stomach without panicking? Understanding that helps you choose investments you can stick with.
So it's about matching the investment, not just to your goals and timeline, but also to your own sort of emotional comfort level.
Absolutely. It's personal. It's not about eliminating risk, but managing the right amount for you.
Okay, this is making it feel much more manageable. So it's practical. What does this mean for someone listening right now thinking, okay, I'm ready to start? You said you don't need a lot of money.
You really don't. You can literally start with a few dollars in some cases. And there are some really smart, simple options for beginners.
Like what? Where's a good place to begin?
Well, if you have a job that offers a 401k plan, especially one with an employer match, that's often the absolute best place to start.
The 401k match. Why is it so good?
Because the employer match is literally free money. They match your contributions up to a certain percentage. It's an instant boost to your investment. Something like 96% of employers offer a match. You're leaving money on the table if you don't take it.
Free money. Okay, priority number one, if you have it. What if you don't have a 401k? Or you want to save more for retirement?
Then a Roth IRA is a fantastic tool, especially for younger investors or those who think they'll be in a higher tax bracket later.
Roth IRA. How does that work?
You contribute money you've already paid taxes on, so after-tax dollars. The magic is your investments grow tax-free, and qualified withdrawals in retirement are also completely tax-free.
Tax-free growth and tax-free withdrawals.
Wow. Yeah. And a neat feature is you can withdraw your original contributions, not the earnings, just what you put in tax-free and penalty-free at any time. That adds a layer of flexibility, though ideally you leave it for retirement.
That flexibility is really appealing. Okay, so those are great retirement accounts. What about just investing in the broader market without becoming a stock-picking expert overnight?
This is where index funds and ETFs are brilliant for beginners. Think of them like baskets.
Baskets.
Yeah, baskets holding lots of different stocks or sometimes bonds. An S&P 500 index fund, for example, holds stocks of the 500 largest U.S. companies.
So you're not putting all your eggs in one company's basket.
Exactly. You get instant diversification, which spreads out your risk, and they're usually passively managed, meaning they just aim to track the performance of the overall market index, like the S&P 500. They aren't trying to actively pick winners and losers to beat the market. This makes their fees much, much lower.
Lower fees, automatic diversification. Sounds ideal for starting out.
It really is. Even Warren Buffett famously advised that most people should just regularly invest in a low-cost S&P 500 index fund. Keep it simple.
Simple is good. And this ties into that idea of consistency, doesn't it? That's saying time in the market beats timing the market.
Absolutely critical. History shows stocks generally trend upwards over the long haul. Trying to guess the perfect time to buy low and sell high, it's basically impossible to do consistently.
So don't try to be a market wizard.
Please don't. Focus on investing regularly, maybe every month or every paycheck, and staying invested even when the market gets choppy. People who panicked and sold during the 2008 crisis missed out on the huge recovery that followed. Sticking with it is key.
Just keep adding right out the waves. Okay, so if index funds are the way to go for beginners, why not just try picking a few individual stocks? Like buy some Apple or something.
It's tempting, right? But picking individual stocks successfully requires a ton of research, understanding the company, the industry, the valuation. It's a lot of work.
More than most beginners have time for.
For sure. And even the professionals often fail to consistently beat the simple market index. Think about Intel. Huge tech stock back in 2000. It still hasn't surpassed its peak from back then. The overall market, meanwhile, has grown massively.
Wow. So you could pick a seemingly great company and still underperform the market average.
Easily. With an index fund, you're betting on the overall economy's success, not just one company's fortunes. It's a much safer starting point.
That makes a lot of sense. Are there other easy ways to get started, maybe even more hands-off?
Definitely. Robo-advisors are a great option. Companies like Betterment or Wealthfront use algorithms. You tell them your goals, your timeline, your risk tolerance.
Okay.
And they automatically build and manage a diversified portfolio for you, often using low-cost ETFs. Minimums can be quite low, maybe $500 or even less sometimes. And they take the emotion out of it.
Automated, emotion-free investing.
Nice. What about those really expensive stocks? Like if one share costs thousands. Good point. That's where fractional shares come in. Most major brokers now let you buy a piece of a share, so you don't need $3,000 to own Amazon stock. You could invest $100 and own a fraction of a share.
Oh, cool. So you can still own parts of those big names, even with small amounts.
Exactly. It makes building a diversified portfolio much easier. And one more thing to mention, especially for balancing risk, is bonds.
Bonds. Less exciting than stocks.
Maybe less exciting, but important. Think of them as loans. You lend money to a government or a company, and they pay you interest. They're generally lower risk than stocks and can add stability to your portfolio, especially as you get older or closer to needing the money.
Like a shock absorber for the portfolio.
Good analogy, yeah.
Okay, this is all feeling incredibly practical and, dare I say, achievable, step by step.
It really is.
Now, we've covered the what and how, the mechanics, but you mentioned earlier that mindset is just as important, right? Cultivating that inner game for financial freedom.
Absolutely crucial. You can have the best strategy, but if your mindset isn't right, it's easy to get derailed. First and foremost, patience and a long-term focus.
The marathon, not the sprint.
Exactly. Investing is a long journey. There will be bumps. The market will go up and down. That's normal. Short-term volatility is just part of the deal. History shows time and time again, those who stay calm and stay invested through the noise are the ones who are rewarded.
It's hard though, isn't it, when the news is screaming about market crashes?
It's so hard. Which brings me to one of my favorite concepts, Benjamin Graham's Mr. Market.
From The Intelligent Investor, right?
That's the one. Graham asks you to imagine the stock market as a business partner named Mr. Market. He shows up every day offering to buy your share of the business or sell you his.
Okay.
But Mr. Market is, well, he's manic depressive. Some days he's wildly optimistic and quotes a ridiculously high price. Other days he's panicked and offers to sell you his share for way less than it's worth.
Sounds familiar.
Right. Graham's advice is, don't get caught up in his moods. You should use his irrational offers to your advantage when it suits you when he's depressed. Maybe sell when he's euphoric, but ignore him the rest of the time. Focus on the actual value of your investment, not his daily mood swings.
Profit from the folly, don't participate in it. I like that. Filter the noise. What's another bedrock principle for mindset?
Warren Buffett's #1 rule, essentially. Never risk permanent loss of capital.
Meaning don't lose money.
Well, yes, but it's deeper than that. It means not just avoiding obviously terrible investments, but also not overpaying for even good investments. Always insist on a margin of safety, buying something for significantly less than you think it's truly worth. That protects you if things don't go quite as planned. Preserve your capital.
Margin of safety. Okay. It sounds like being a good investor is also about constantly learning.
Totally. Continuous learning and self-awareness are key. The market changes, you'll make mistakes, everyone does. The important thing is to learn from them.
And knowing yourself.
Yes, understand your own investor personality. Are you easily swayed by hype? Are you overly cautious? Knowing your biases and tendencies helps you build a strategy you can actually stick with. Maybe look up something like the BB&K model it categorizes. Investor types like individualist, adventurer, guardian. Just helps you understand yourself.
Interesting. Know Thyself Investor Edition. And what about our maybe deeper relationship with money itself? Any tips there?
Oh, huge. Reframing your money mindset can be incredibly powerful. First, watch your language. Instead of I'm bad with money, try I'm learning about money or I'm making progress. Focus on wins, however small.
Positive self-talk.
Yes. Second, be curious, not judgmental. If you slip up, like overspending, don't beat yourself up. Instead, get curious. Why did that happen? What was the trigger? Journaling about it can reveal patterns.
Interesting approach. Less guilt, more understanding.
Exactly. And third, make managing your money less of a chore. Set a regular money date. Maybe it's just 5 minutes a week to check your automated savings, or an hour a month to review statements. Make it pleasant. Grab a coffee. Put on some music. Turn it into a positive ritual, not something you dread.
A money date. I love that. Make it intentional. Make it maybe even enjoyable.
Why not? It's about taking control and building that future you want. It supports that whole entrepreneurial drive.
What an absolutely fantastic deep dive today.
Yeah.
Seriously, so much practical stuff packed in there.
Yeah, we covered a lot of ground.
We really did. From, getting that financial house in order, emergency fund, knocking out bad debt, to understanding that incredible power of compounding.
The eighth wonder.
Totally. And then looking at simple, smart ways to actually start investing 401k, Roth IRAs, those index funds, while keeping that patient long-term mindset ignoring Mr. Market's drama.
Couldn't summarize it better. And just a crucial reminder for everyone listening, everything we talked about today, it's purely for educational and informational purposes. This isn't financial advice. We're here to share knowledge and perspectives to empower you, not to tell you exactly what investments to buy or sell.
Absolutely. Always do your own research or consult with a qualified professional. But if you found this deep dive helpful, please do subscribe.
Yeah, and share it. Share it with friends, family, anyone you think could benefit from building their financial confidence.
We really believe this knowledge is empowering, helps unlock that potential. And we'll keep digging into these topics.
Definitely. We've got future deep dives planned on stocks, ETFs, technology and finance, financial planning, lots more to come.
And make sure you join us for the very next one. How to build wealth with low-risk stock portfolios.
Looking forward to that one.
Me too. So until then, here's something to think about. What does living without limits truly mean for you? What amazing things would you do? What dreams would you chase if money wasn't the primary obstacle? That freedom. That's the real prize we're working towards here.